Hello everyone, today's video we are going to look for financial ratios. So what is ratio? Ratio, in a sense, we are comparing with two numbers or two things, then we will give the output, right? We are giving for the justification what is a relationship between the two figures, that is called it as ratios. And from your financial ratios, this will be very helpful for the investor, those who are taking for investment decisions. That's very helpful, and it's one of the fundamental analysis. The analyst as well as fund managers, they will look for the ratios, and after that they will take for the decisions. Even though if they are focusing for technical analysis, first they will focus for the fundamental analysis. Mainly the 95% they will focus for these ratios and they will take a decision of it. That is what we are going to look in this video one by one. What are the ratios will be available and which ratio will be helpful for the investor, and what is the investment decision they need to take it with the help of the output. That is a thing we are looking this video. Okay, if you're a new user, in a sense, you can subscribe this channel and keep on watch. If you're already subscriber, you can look as a whole video, then leave your comment below. If there is any query, you can comment below, I will help you out. Okay, let's see. This is what the agenda for this presentation. The first thing will be valuation ratios. Many ratios will be available. Okay, for investment decision, if you want to take it in a sense, these four major part of ratios will be helpful to you. Under these four major parts, some metrics will be available below on it. Okay, evaluation, in a sense, you can take it for 20 ratios, but those 20 ratios we are not going to take it for taking for the investment decisions. Maximum for 5 to 6. That is what we are going to look. Each and every ratios, valuation ratios, profitability ratios, liquidity ratios, solvency ratios, these all those things, what is a major part which is helpful for the investor in order to predict for the stock price movement. That is what we are going to look in this video. And from this we are looking for what is the meaning of it and what is a formula, how we can get for the result. Because right now we are not going to calculate, but even though you should know what is a formula, the value has been arrived with the help of websites. Okay, many websites is available, that's already available predetermined data. Okay, but you should know how you got at those kind of detail. So that's the reason we are looking for the formulas, as well as with the help of the result, what decision you are going to make it as an beginner, as an investor. That is what the thing we are looking this video. And this video will not cover for all the ratios. Profitability, liquidity, as well as solvency will come for next video onwards. And this presentation will focus only for the valuation ratios. And valuation ratios will be available for more than 20 ratios. Okay, more than 20 ratio will be there. But from here we are focusing major 5 ratios, which is very helpful for taking investment decision. Okay, that is what we are looking. And what is valuation ratio? In a sense, we are estimating for the future earnings. The ratio meaning I already told you, but for valuation ratio, in a sense, we are going to value for the company in order to get future earnings. Okay, that's the reason the valuation ratio will be helpful for the investor. How we are calculating for the valuation ratio? The relationship between the market value as well as different financial metrics. Different financial metrics you already know. We already looked for EPS, right, and return, revenue, growth. These kind of metrics, call it as financial metrics. Okay, with the help of these metrics we are going to calculate for the valuation ratios. And from here we are focusing top 5 valuation metrics. Okay, that is what we are focusing over here. The first one will be price earning ratios. Price earning ratios, everybody knows. I already posted one video earlier also. What is EPS and what is price earning ratio? How we are going to take a decision of it. Okay, that video you can look at, you will get full insights. Okay, so from here I'm not going to explain more on it, but in a gist way I will tell you what is price earning ratio. Okay, what is PE ratio? PE ratio, in a sense, to value a company by comparing the price of stock towards earnings. Generally what people will say for price earning ratio, which they are looking, when it will be double our capital. Okay, if you are putting for 1 lakh or 2 lakh, everybody will expect for capital appreciation. Okay, so they will look for the PE ratio, within how many years our amount will be doubled. With the help of that they will look for PE ratio. Okay, in another scenario the people will look respective stock price, it will be undervalued or overvalued with a comparison of other related companies with the same industry. Okay, they will compare it with the industry PE ratio, then they will determine whether it is undervalued or overvalued. So this full explanation available in this video. Furthermore, okay, what are the types of P ratio is available, how company is calculating, what is the formula of it, that trailing P as well as forward P, everything else you can look in this video as well as you can get it. Okay, so normally a statistics point of view, the company P ratio below 25 is good. Below 21 to 25, okay, that will be very good. Okay, that means for 18 to 25 it's very good if you're looking for price earning ratios. So now we can look for the company which has a price earning ratio, what it will be and how we are going to take a decision of it. That is what we are looking over here. Okay, so now I will show you from this one example. From here you can take it, price earning ratio. See here, it's available for 10.9. okay, so this is related to software company. So price earning ratio, it's available for 10.9. so what you need to do, from the below same peer that is a pure company, that is a same similar company, other same software companies, you have to compare it. The P ratio which is available for 29,833, this isn't all too much, right? So you can compare it, whether you are comparing with other pure companies, this will be low. It means what? That's a good P ratio, you can invest, okay, for this Microsoft. That is what the solution, that is what the impression you need to take it for this kind of P ratio. This is in terms of for Indian stock market, whether we are going for this one UAE stock market in a sense. Price earning ratio, you can look over here, it's available for 4.65, 8.3. okay, so this one will be good only, right? So it's below 25. So this is a way you need to look for companies and you have to take a decision of it. Another company we can go for Emirates Islamic Bank. You can look for price earning over here, it's higher, right? From the beginning of the years and all, it will be higher, and right now 2023 it is 17.5, it's normal only. That's a range of within 25, it's available. Okay, so with the help of this one we can take a decision of it. It's well and good price earning ratio, right? So this banks you need to compare with the other bank. This is also a bank, and this one Emirates NBD also we looked. While you're comparing with these two banks, this will be very low, right? So it means undervalued, we can buy while compare with the Emirates Islamic Bank. As the same way, whatever company you're going to invest, that belongs to which industry, you need to compare with the other companies also with the same sector. Okay, then you have to take a decision of it, whether you need to invest or not. So right now we look for price earning ratio, we compare with the Indian market as well as UAE market. Now you could know whether you're going to buy a stock or not. Okay, that is what the investment decision you need to take it regarding of P ratio. And for the second one, price to sales ratio. Price to sales, these all ratios will be comparing and getting revenue generated from equity investment. What is a revenue? It has been generated from the equity investment. That is what it is showing, but different parameters. Okay, the first one calculated with the earnings they are comparing, and the second one calculated with the help of sales. Okay, so different parameter they are taking and they are valuing for the company, because if one value might be good and other value will be negative, in a sense they are not focusing for the sales. In over a period of time we could know, okay, if the sales is less, in a sense automatically the company valuation will be low. That's the reason different parametrics they are looking and they are comparing, and overall they are giving for the good result. Okay, so for the second one will be price to sales ratio. So with the help of sales ratio they are calculating this one. The formula will be market capitalization divided by total sales or revenue. Suppose total sales is not available, in a sense you can take it for revenue. Okay, market capitalization, you know, the share price into outstanding shares. If you are multiplying, in a sense you will get for the market capitalization. So this price to sales ratio, if it is getting for some result, what's the decision you need to take it, in a sense? If it is available price to sales ratio 1 to 3, okay, some companies it will show for 1 and 2 or 3. Within the range of 1 to 2 it will be good. Okay, and less than 1 or exceptional, in a sense very rare, less than 1 will be available for price to sales ratio. If it is available, in a sense more good. Okay, if it is that means what? Undervalued stocks. Okay, if it is more than 3, that will be high risk company. Okay, they have high risk in a sense, how we can say, for banking sector they have they distributed for more loans, they did not get for repayment from the customers. Okay, in terms of retail industries, if you're taking in a sense, for suppliers as well as for suppliers, they did not return back for their money. Okay, such kind of things you can consider. So 1 to 3 will be good. Okay, and less than 1 is also more good. If it is more than 3, in a sense, we can consider it will be high risk. Okay, but this will be vary, depends upon the sectors. Okay, general impression you can take it, depends upon it. Now let me see for the companies price to sales ratios. See, from here it's available high, right? Emirates Islamic Bank, the year which they have given 22 and 23. Okay, and currently you can look, price to sales ratio will be 5.86. right now they are thinking to reduce, right? So if it is coming for 3, in a sense, well and good, you can take a decision of it. Okay, you can buy a stock. If you're going for same Emirates NBD Bank, you can look for price to sales ratio will be 1 to 3. So our impression already we told 1 to 3, in a sense, it is good, they are running good, right? The sales will be correct only, they are providing for the loan, as the same way they are getting back, the customer will be repaid in a proper way. So they are running their business in a well manner. That is what represent for this price to sales ratio. You can compare for Indian market. Okay, just you can select for Axis Bank, or else any company you can select it. Okay, not only this one, any company you can select it. See, from here price to sales will be 3.20. Same way you can compare for SBI. Okay, one government sector as well as one private sector we can take it. So government sector price to sales you can compare for 1.68. so we'll compare with Axis as well as SBI. That is, SBI is good. Okay, Axis is not that much better, so you can take a decision of it. SBI you can invest, we'll compare with the Axis. Now you can understand how you can take a decision of it with the help of price to sales ratio. Okay, that is a way you can take a decision of it for the price to sales. And next one, price to cash flow ratio. This is very important ratio. How much of money an organization produces comparative with that stock price. Everything, these all valuation ratio, how much of money the company has been produced with the help of stock price in terms of sales. Okay, in terms of sales, how much they are producing. In terms of cash flow, how much they are getting. Okay, that kind of comparison, because ratio already we told we are comparing with the two figures. So from here they are comparing the figure stock price with the help of cash flow. Okay, so the formula will be here for the share price, in a sense, current market price, okay, divided by operating cash flow per share. For operating cash flow, how will you calculate? Operating cash flow per share you can calculate operating cash flow divided by outstanding shares. Okay, so with the operating cash flow, how will you calculate? Net profit plus non-cash expenses plus cash changes in working capital. Working capital, normally people know the day-to-day expenses the company will meet, that is called it as working capital. Okay, so from here non-cash transaction, in a sense, what is non-cash expenses? That is what given here: depreciation, amortization. Depreciation, or what's the difference between these two, depreciation and amortization expenses? Depreciation as well as amortization expenses, both will be expenses only. For fixed asset, whatever expenses will be coming, that is a tangible asset or fixed asset we can say. Okay, whatever expenses will come, that we call it as depreciation. Okay, for intangible asset, whatever expenses will come, that we call it as amortization expenses. Okay, intangible asset, in a sense, say for example we can say for patent and copyright, goodwill. Okay, these kind of things we can say for intangible assets. So whatever expenses will be coming for those assets, that will be called it as amortization expenses. Okay, and fixed asset, normally you know that we call it as that is a tangible asset. Tangible, in a sense, what? If you're touching for a particular asset, you can feel it. Okay, that should be a visible. Tangible, in a sense, we can see those things for your car, for your house. Okay, for your machinery, for your furniture, these all those things come under fixed asset. So whatever expenses will be coming, those things we can call it as depreciation. Okay, that is what the difference between these two. Okay, another thing also will be their unrealized losses. Okay, in terms of banking point of view, if you're looking for interest and those things and all, it will come deferred income taxes, asset write down, provision for future losses and everything else. So this calculation manually you're not going to do it. Okay, but if it is helpful, in some website it is not available, only for the detail is available, they not even provided for price to cash flow ratio. In a sense, with the help of this formula you can calculate. Okay, so now you will ask, what is the decision I need to take it? The price to cash flow ratio that is more than 1 to 10, the range between 1 to 10, in a sense, it is good. Okay, the company cash flow will be there, the positive cash flow, they will run in a proper way with the help of operating as well as financing cash flow, everything else. Okay, if it is less than 1, in a sense, we can think that it is a strained financial standing of the firm. Strained in a sense, what? In a banking sector we can take it, I provided for a loan. Okay, so the customer did not return back to me in terms of repayment period. Okay, for a fixed period, it's 4-year duration I am giving, right? So if there is any some customer, they will not pay for a particularly, and we will call them and we will give a penalty, such kind of things, and it will show in the balance sheet as bad debts, right? Such kind of things and all. So this is in terms of banking. If you're looking for production industry, in a sense, what will happen, the supplier, sometimes they will not, supplier as well as for the salesperson, they will not return back their money. We are giving for the goods, they will not return back for the respective amount of goods, such kind of things. Okay, so the company provide the money to outside people, but the outside people, they will not return back on time. That kind of company under for financial strained companies. Okay, this is a way we can consider. This result shows for this one, so we can consider 1 to 10, in a sense, it will be good. Let me check for this one. Cross check. Okay, this is related to for Indian company. Okay, it's for Indian bank. Okay, State Bank of India. Price to cash flow, you can look for 34.1. We told for that is 10, right? So it means what? The repayment, most of the people, they did not repay for their loan. Okay, that's the reason it is higher. You can compare with the private bank. We can compare for ICICI. Okay, what's the price to cash flow will be there? It's 4.98. It's good. Okay, so most of the people who are getting the loan, they are paying for their repayment in a proper way. So now you can take a decision of it, which is good. The ICICI bank is good while compared with the SBI in terms of price to cash flow. Okay, as the same way we can go for this one, our UAE market. Price to cash flow ratio, you can look for the current 4.43. It is well and good for Emirates and BD. They are following for price to cash flow, that range. Okay, within 10 it's available, it's good. You can go for Emirates Islamic Bank. The price to cash flow, it's available for 9.14. That is also fine. Within that range, it's available. So in terms of price to cash flow, it's good. You can look for this one. Each and every ratio, that should be different. If you're looking for price to sales, in a sense, it's higher. You will not take a decision of it for investing this one. But if you're looking for the cash flow, it's good, you will invest, right? This is a way you can compare it. So out of 5, how many ratios will be normal? Then you can take a decision of it whether you are going to invest or not. So now we compared for Indian market as well as for UAE market with the help of price to cash flow ratio. Next we can move on to price to book ratio. Price to book ratio, how much of money an organization produces comparative with that stock price. Same thing only. So how much of money they are producing with the help of stock price. Okay, so this is what the formula. All the ratios will not helpful for all sectors, and some ratios may be fit for some sector and some ratios may not be fit. And price to book ratio, from here it is not fit. That is a service sector as well as IT sector. Why? Because these two sectors, the tangible asset in a sense, the fixed assets will be very low, right? While compared with the manufacturing industry and production industry and all. Okay, so this price to book, these two sector will not give a proper result. You not required to compare these two price to book ratio. That's the reason given over here. So how will you calculate, in a sense, market price per share divided by book value per share? Market price per share, normally you know what is a trading price in a market, that is what market price per share. And book value per share. Book value per share, how will you calculate? Total asset. Already we told the book value in a sense what? Total asset minus total liability. So from here it's available total asset minus intangible assets minus total liabilities. okay, divided by number of outstanding shares. Intangible assets, I already told you that copyright, patent, goodwill, these kind of things will be intangible assets. Okay, with the help of total asset, you need to deduct this one, or else what you need to take it, you have to take it for that is a tangible asset here, then you not even consider this one. Okay, so not required to confuse, take it as a total asset value and minus intangible asset as well as minus total liability divided by number of outstanding shares you will get for book value per share. With that, you can divide for market price per share, you will get for price to book ratio. So what is a decision I can take it in a sense? If it is above 1, okay, that is high growth, financially distressed. If it is under 1, in a sense, low ROE and high BP, high price to book ratio, that is a overvalued growth stock. Low return on equity and high price to book ratio, in a sense, you can take a decision of it, is overvalued stock. Okay, let me compare return on equity as well as book value. You can go from here, return on equity and price to book value. See here, it's available over here. So return on equity should be what they told over here, a low return on equity and high price to book. From here 20.6, that is a high, it's not a low. Okay, so it means what? It is undervalued. If it is low, in a sense, we can say for overvalued. Okay, so it's undervalued only. ICICI, we can check for SBI right now. So return on equity will be how much? Return on equity will be high only. Okay, so if it is low, while compare with price to book, then we can say for undervalued, right? Yes, we can say for undervalued. Right now it will be overvalued stock. So now we can go and look over here as a same another scenario also I have given. If it is above 1, in a sense, that is a high growth. If it is under 1, in a sense, financial distress. So from here, both the thing, it's not available. So from here we can check price to book. If it is above 1 or less than 1, it is less than 1. Okay, financially distressed, it means what? Same thing, a few people, they are not giving for their payment. Okay, so same way this one, EIB, you can go, that is a price to book ratio will be above 1. Okay, it means what? 3.16, that is a growing. This bank will be, as per the financial, it's a growing sector. Okay, so price to book ratio will be helpful. With the help of that respective company will be growing level or distress level. Okay, that is a decision we are going to take of it. As the same way, we can compare with return on equity. Return on equity, from here you can compare, return on equity will be 20.49. So this will be the higher. Okay, if it is lower, in a sense, it is overvalued. It means what? Overvalued. If it is under, in a sense, we can say for undervalued stock. Okay, so from here 3, suppose from here it's available for 24 or something like that, we'll compare with these two, then we can take it for undervalued or overvalued. Okay, Emirates Bank, we can check it, price to book ratio, that is 0.97, that is less than 1. Okay, we have to keep it for more than 1 for price to book ratio. Okay, and while you are comparing with return on equity, that is what the decision you have to take it. Okay, then we can move for another ratio called enterprise value. Okay, for enterprise value, it's very, very important. It measures the overall business total value it will calculate. So for enterprise value will be calculate the overall business. Okay, the formula will be market capitalization plus market value of debt minus cash and cash equivalents. Okay, cash equivalents I already shown over there from the previous slides. Okay, and for the impressions, what you need to take it in a sense, a company with a high enterprise value relative towards market capitalization may indicate higher debt burden. Okay, so what they are telling in a sense, you can go over there. Okay, market capitalization, it is available 32.58. Okay, the enterprise value will be here, right? And you can go for this one, market capitalization will be 32 billion, and from here enterprise value will be 42 billion, right? So from this one, enterprise value is higher while compared with the market capitalization. It means what? Some debt will be there. Okay, In some other cases, the market capitalization will be higher and this will be lower in a sense. That is well and good. Okay, in 98% such kind of cases may not be available, so they have given in another valuation. You have to compare with EBITDA. Okay, this is what the example for UAE market. Okay, so this is a way you can compare with Indian market also. Okay, I think this video will be very helpful for you. If it is helpful, you can subscribe this channel and keep on watch, and you can if there is any query, you can leave a comment below. I will help you out. Those who are not subscribed this channel, you can subscribe this channel and keep on watch whatever video I will post regarding the stock market and all. Immediately you will get in your notification. Okay, thank you friends, thank you for watching this. Bye.